Feeling like a shark in a shrimp tank. Big fish, small pond in the shrimp tank.
Hey, good afternoon, everybody, and welcome to the Shrimp Tank, brought to you here in our virtual Shrimp Tank studios. We could be outside at our studios in Woodstock or in here at Alpharetta, Georgia, but today we're doing this via Zoom as we have a resurgence of the coronavirus here across the country. We'll talk actually a little bit about that today. Every week right here on the Shrimp Tank, I'm your co-host, Ted Jenkin, with my co-host, Lee Heisman, broadcasting across the nation in many of our cities where we are right now at the Shrimp Tank: Seattle, Los Angeles, Houston, Little Rock, Boca Raton, Charleston, Harrisburg, Boston, the state of Tennessee, and even the North Lee, the territory in Canada right now where we are producing the Shrimp Tank. It's really been amazing growth because every week we get to talk to some of the brightest and best CEOs and entrepreneurs and brilliant technical minds. Talk about the business of being an entrepreneur, folks. Like, how do you start? How do you grow? How do you run a business? What does it mean to your wallet? And how can you make a business start at nothing and grow it into millions and millions of dollars? We have interviewed, Lee and I, some 250 people, just ourselves, and more than 1,000 on the Shrimp Tank across the country. Top people like the #1 real estate agent here in the state of Georgia, the Williamson brothers, a top-selling barbecue sauce company, and so many other just crazy, amazing businesses that are out there. Today, in just a minute, we'll bring in our guest, Kevin Simpson, who's the Chief Investment Officer of Capital Wealth Planning, and they talk to you about some of the strategies that they use with clients, which, by the way, you might want to get in on this. It's going to be some interesting stuff as we see what happens as the markets unfold, especially in a presidential election year. As always, you can get a replay of all of our fabulous broadcasts at shrimptankpodcast.com, or you can download us on iHeart, where we are ranked very high in the entrepreneur area. You can get us to Apple Podcasts, Google Play, Stitcher, SoundCloud, or anywhere around the internet. And Kevin, you know, we normally open up, Lee and I, and talk a little bit about the economy. But given the week that we're in right now, and Lee, I wanted to ask your thoughts about this. So there's this scenario that's being played out in America right now, and I think about it as people in one camp and another camp. There's a camp of people out there that believe that the people that are getting this $600 of extended unemployment benefits are literally at home eating Cheetos and playing video games and saying, hey, I'm getting paid more not to work than to go to work. And then you have another camp of people that are basically saying, let's stop this $600 because people will never get off their couch and come back to work. And business owners out there, some of them are saying they're having a hard time hiring people because at a $8 or $10 wage job, they just can't compete with getting free money from the government. So I'm wondering what your thoughts on it here about that in general, and how do you think this will shake out with this $600?
Well, you know, I think that most of your listeners are entrepreneurs and wouldn't be able to sit home on a sofa playing video games for more than maybe an hour or two before, you know, we go stir crazy. I think it was a wonderful gesture, a very important thing to fuel the economy, to make sure that we were in this unprecedented level of unemployment, that we were still able to allow the consumer to have some semblance of normalcy with a few dollars in their pockets. I think what we'll find today is that the GOP will come out and make a recommendation to continue a semblance of that. I'm hearing somewhere between $200 to $300 a week.
Right.
So it would go down from $600 to either $200 or $300, which I think would be a terrific compromise. The coronavirus is not anything that we asked for. It's not something that the American worker should be held responsible for. So I like the idea of a stimulus, and I think the fact of reducing it but not taking away is a great compromise.
And Kevin, you know, regarding our listeners, as you said, they are entrepreneurs, of course, and people that want to be entrepreneurs. But that original check that we spoke of, you know, the first one that was $600 a week, it crippled many of our entrepreneurs. It absolutely crippled them with trying to bring their staff back when opening. So again, the $200 to $300 option, will that be crippling, you think, people wanting to go look for a job? And by the way, how long will this be going on, gentlemen? How much longer is the new package supposed to last until?
Well, I think we'll find out a lot more about that today, but paying someone $200 or $300 a week may be enough to, again, tilt that scale a little bit to get back to work.
Yep.
I think also just the concept of staying at home is a fleeting fancy. I'm wearing shorts. with a dressy top, as I've been doing for months. It's like a mullet, and I'm tired of it. So just speaking for me, I'm anxious to get back to work, and I feel that there's probably lots and lots of other people who are just as enthusiastic from a self-worth standpoint to kind of see things return to normal. Now, of course, they can't return to normal because the coronavirus, the COVID-19, is no different today than it was when this started. So until we see therapeutics, and I don't expect that to be something that's a reality until next year, we're going to live through this together, and in some cases, we're going to stumble through this together.
Lee, I'm curious about what you think about this, and Kevin, what you think about this, but I read a story this week that Yelp, one of the agencies that lets people rate and rank things, said that 60% of the restaurants on Yelp have said that they have closed. And I'm wondering, if one of the issues here is whether jobs will actually be there. We were at a 50-year low in unemployment, and then within a month, we hit an 80-year high in unemployment. And so do we actually think there's going to be jobs for lower wage workers to go back to work? And Lee, are you seeing in Atlanta here too, business owners that are telling you they put hiring on pause?
So I will tell you, in Atlanta and in the market with most of our CEOs, it is very industry specific, Ted, as you know this. And Kevin, in Atlanta, we pretty much reopened April 27th. And we have had our foot on the gas ever since April 27th. We have not held back at all, of course. And our economy here has been wide open. There have been some modifications, as you know, Ted, for restaurants and for social distancing. And recently, thanks to some organizations such as Target and Walmart and Kroger's and supermarkets, they're requiring masks, of course. And I just read an article this past weekend that the surge in Georgia, we actually had a downturn. There were close to 4,000 cases every day last week. And now this past weekend, there were closer to 2,700 new cases on Saturday and on Sunday. And now I'm not toasting the champagne glasses. I'm simply saying that the past 2 weeks of mask wearing in this region where I am, maybe we're beginning to see an impact in that. But I will tell you, certain industries have increased. I will tell you, Ted, in my experience with all of our previous guests that we've had on the show, real estate is nonstop. Closing attorneys are nonstop. Real estate agents are nonstop here. Restaurants and retail, I've noticed, has been crippled. And a lot of our business owners that we know are just trying to hold on. But don't forget, we also have warmer weather here, a little longer than the rest of the country. And the more south you go, so you can accommodate with more outdoor seating to try to distance people a little more. So I found it to be, Ted, very industry specific. Some industries are thriving and others are really having a tough time just trying to hold it together. Kevin, your thoughts, as I know you're usually out of Florida, but today you're in our home state of New Jersey.
Woo!
What are you seeing or noticing? I know, New Jersey.
Born in Jersey.
Sorry, I said it wrong, Ted. You're in our home state of New Jersey. I didn't say Jersey.
Well, I will comment specifically on Ted's question having to do with restaurants, because I pay close attention to how crowded they are outside. They opened very recently. Florida, like Georgia, we had been open for outdoor dining. New Jersey was very late to introduce that, to their credit. Now they're practicing a very safe outdoor experience. And of all the places that I've looked at around here, I've only found two very small restaurants that don't appear to have survived, that don't appear to be in business at the moment. Whether they will come back, whether their employees will have a job at some point, I'm not optimistic on those two. But every other restaurant that I've looked at has been open. I don't know what their books look like. I can't imagine that they're profitable. If you have half the occupancy and you're outside, I doubt that they've doubled their prices. Probably even more impactful in Manhattan. I haven't been up to New York yet, but I think it's encouraging to see the commerce that I'm seeing. And it really is important, because everything that we think about is fueled by the consumer. Lee, you mentioned housing. Ted, you probably would point to low interest rates as being such a powerful component, not only to new homes, but also to refis. If we have people that are refinancing, then there's more money in the budget that could then be recycled into consumption. And people staying at home a little bit more, without movies, without sporting events, with reduction in dining out, we absolutely have the ability to get this economy out of a recession much sooner than we ordinarily would have if it wasn't a self-induced recession. So I think I'm a little bit more optimistic than some people from the economy. And I'm also realistic enough to think that we're 12 months away from maybe being through this fog.
Real quick, Kevin, it's a very, very important point. You've seen recently, if you've been watching television, you know, how many sporting events have you seen, right? You've seen the Major League Baseball season has started again, which was really quite intriguing. If you haven't watched the game, you must put that on. I watched an inning with some mannequins, or there were actually some stuffed animals in the stands, and they filled it. I watched one inning of a New York Yankees game where there was no one in the stands. Then I watched an inning of another game where they actually had the fake, you know, poster boards of people in the stands. And psychologically, although I knew it was fake, it made me feel more comfortable. After a strikeout, you actually had the fake sound of cheering fans, which actually made me feel better. But that, as you said, the consumer level of comfort with the NBA soon to be starting, I think any day now, NHL is starting. With sporting events coming back, although we don't have active fans in the stands, does that lend itself to your positive mentality on the economy because you have this normalcy slightly returning?
Yeah, Lee, it did this morning. I wrote in my commentaries quite a bit about baseball being back. I listened to it on the radio, so it sounded even more normal. I put a really eloquent quote from Field of Dreams in. And then a short while ago, I found that the Miami Marlins have quite a few positive COVID-19 tests. They're staying in Philadelphia. They're not traveling and having a game with Baltimore tonight against the Orioles. And at the same time, the Phillies-Yankees game was canceled today for fear of the visitors' dughouse having infections, so that we're not bringing the Yankees in to expose them to that. So you have a little bit of normalcy. You get excited for something, and then you take one step back. Basketball has a tremendously good chance of succeeding because of the bubble. Hockey, I think, the same way. And your Canadian Shrimp Tank podcasts will be able to get a lot more viewers and a larger audience as they quarantine in 2 Canadian cities. But baseball did feel great this weekend. I hope that it can continue. And although it's not the same and it's not normal, it's giving us a glimpse into what normal will look like again. And I don't want to hear anything about the new normal. I don't care about a new normal. I want things to be normal. And I think that's the goal and the quest that we're all looking forward to eventually.
So Kevin, let's talk a little bit about your business. You know, there obviously, there'll be a lot of people watching the broadcast, and a lot of people really don't understand the money management strategies that they're in. And you offer something called a separately managed ETF, an equity portfolio that also is complemented with a yield enhancing cover call strategy. Can you translate that for the average person? Because Lee, when I said all that, did it sound like German or French or something like that?
Yeah, I'm an outlier right now. So just be crystal clear. For any of you listening or watching this right now, I'm your voice, because we're here with Kevin, who's a genius in this realm. We're here with Ted, who's been in the financial industry world for decades. So when you hear me speak up, it will pretty much be the voice of the listener asking questions. Please, Kevin.
Well, Ted, you made that a mouthful for sure. But you know, there's not that many people better at simplifying financial planning than you. And if you think about what we do in the world of investments, we're one of the sleeves, one of the components that a financial advisor may recommend to a client. So Lee, you work with a financial advisor. They put together an asset allocation model where they say you should have some investments that are in safer allocations. Maybe those are going to be cash equivalents or bonds, and then maybe you have a little bit of money into the stock market, which is going to have a higher degree of risk because, you know, stocks go up and down, and certainly this year it's been a microcosm of that lesson of up and down and volatility. And we're a component, we're a money manager that focuses on large cap blue chip companies, and we invest in companies that pay dividends with an emphasis on companies that have an increasing history of dividend growth. And our methodology for that is, although we want to be invested in the stock market, we also want an income component in an equity income portfolio. I don't know if I did a better job, Ted.
Yeah, no, I think, Kevin, the way I encourage most people to think about this, I've always said this because I am a simpleton in explaining this stuff, is that there's really only 2 ways you can generally get investments. You're either a loaner or you're an owner, right? And so what happens is, in this case, is that if you have a company let's say it's AT&T, you can loan them money and they can pay you an interest rate. But in this case, you become an owner where you actually own the stock. They pay you a dividend every year because you're actually part shareholder in the company. And then you develop, which is really, I mean, it's so incredible that you can get this hardly anywhere, Lee, a strategy where you can actually enhance that dividend, right, and make it more than it normally would be from the company.
Yeah, well, we utilize a very conservative technique of covered call writing. And covered call writing in and of itself is something that may not be as mainstream, but it's a technique that allows for us to buffer a tiny bit, to buffer a little bit of the downside of the portfolios. So we look at it as a hedging technique. But the byproduct of that is that it is a cash flow. We are generating an income stream. And generally, by writing covered calls in the format in which we do it, we will, I guess, somewhere between 2.5% to 4% a year be a target ratio, depending upon how volatile markets are. So we own dividend-paying stocks.
Yeah.
So we try to get between 2.5% and 3% a year from companies like AT&T that are paying us a dividend. We hope that over time their stock prices are appreciating as well. But that dividend is very powerful, especially in a year like this where we're down or flat. And then by utilizing covered calls, if we can bring in another 2.5% to 4% a year on top of the dividend, now we're driving a cumulative cash flow of 5 to 7%, which in a zero interest rate environment, hooray for refis and new homes, but not that great when you're a traditional CD or treasury bond investor. So if we can get 5 to 7% cash flow, that can be a very powerful
Lee,
income.
here's how this deal works. And Kevin, tell me if I'm wrong about this, and then we'll get into some of the business. Like Lee just got a Tesla, right? And so let's say Lee's Tesla is 100 grand. What happens, Lee, is I say, I'm willing to pay you $2,000 of cash right now for the ability to basically still be able to take that Tesla for you, take that Tesla from you at $100,000. Let's just say your Tesla goes to at $110,000. Let me explain it this way. Your Tesla's 100 grand. I'm going to give you $2,000 for the right to buy your Tesla at $110,000. So in this case, if your Tesla all of a sudden tomorrow gets valued at 120, I can still buy it from you for $110,000. However, if it never gets to 110, you got that extra 2 grand from me for just giving me the option to buy that Tesla from you at $100,000. Does that sound reasonably directionally right, Kevin?
Well, I would like to hear Lee's opinion.
I understand it, and it's risk and reward. So it does make sense to me, Ted, and it's all based, if it were me, it's all based on the value of how much you're offering up front. And it seems it's a risk versus reward game. If we're dealing with millions of dollars, there's a risk and a reward. What's my loss? What's my risk in that scenario?
Well, we've never done this with the Tesla before, so this is fun, Ted. Usually I think of an appreciating asset. I didn't know there was a massive secondary market for used Teslas, but maybe there is. So in our example, your risk, Lee, is twofold. When I think of your risk as your asset depreciating in value or going down. So whether it's your Tesla that you drove off the lot and now instead of 100, it's worth 80. No offense to Tesla. I mean, I think Elon Musk is phenomenal. I hope he's a guest on Shrimp Tank soon because I'll be tuning in. When I talk about that analogy, I often look at it in the real estate world because sometimes it becomes a very commonplace with lease options in real estate. So taking Ted's example and saying, well, maybe this was on a condominium, and you have that scenario where there's a good likelihood of appreciation. We do it with stocks. So let's just pretend we were doing it on Microsoft, and we'll pretend Microsoft was $100 a share. Just like in Ted's example, we would say, well, Lee, we'll pay you $1 today to have the right to buy 100 shares of Microsoft from you next month at $105 a share. So today it's 100. We're willing to pay 105 because we think it's going to go much, much higher. And when you're selling covered calls or when you're selling calls on Tesla automobiles, the great thing about it is that we're generating that income. We're bringing that money in, whether the investment goes up, down, or sideways, whether real estate stocks or the used Tesla goes up, down, or sideways, we're keeping that premium. In the world of risk, our risk is that those assets go down. So if Microsoft went from $100 a share down to 20, That would be, a pretty big risk. If the real estate went down, if the Tesla went down, our risk is lost to the downside. Also, in covered call writing in these contracts, we're selling someone the right to buy something from us at a price higher than it is today. But it could certainly go higher than that. So if your Tesla goes to 120, if Microsoft goes to 110 or 115, if the real estate appreciates buying the lease option price, we're capturing some, but not all of the upside. So the criticism against covered call writing often is, well, you forfeit some upside. You can't make all of the unrealized upside appreciation. And I would submit that that's absolutely a fair criticism, and one in which we're very willing to engage in. We don't need to make home runs. We're in the business of trying to make.
Kevin, explain why you can't make all of that. Use the Microsoft example, right? You pay me $1. I have Microsoft at $100. You pay me $1 to be able to buy it at 105, right? And Microsoft is at 120, and then you engage that and you give me the 105 for it. Do you not realize the $15 delta immediately?
Well, as the seller of the covered call, as the owner of Microsoft, I'm obligated to sell it to you at the 105 strike price. I forfeit the $15 that it appreciated to 120.
Got it.
The person who purchased the call, what a home run that is. $1 to make 15 is a pretty good return. But our process, again, is looking at large cap blue chip companies for a more conservative investor to supplement some upside potential, forfeiting some of the outlier upside to produce good returns with a heavy emphasis on income. So I would say that in a covered call strategy, you're never going to outperform, or very rarely you will outperform the market to the upside, because by nature of the strategy, things will get called along the way. However, what's more important to us is we don't want to be participants in all of the downside. So if we can buffer and hedge some of that downside and have less downside participation. Ben Graham talks a lot in his books and his writing about the essence of portfolio management being the management of risk. And in our firm and at firms like ours, we feel that if you can manage the downside, if you can manage the risk, the upside can take care of itself.
So let me ask you a question, Kevin. I'm that outlier. I'm the outsider here. And I think, Ted, I texted you this one time a few months ago when I saw an amazing statement. I'm going to do my best. I didn't prepare this today. But for us ignorant people in the stock market, unlike you two, is the stock market just a graph, an emotional graph of rich people's feelings and how they feel that day? Wasn't that the term, Ted, if you remember correctly? Was it the stock market is an emotional graph of how rich people feel?
Yeah.
Is that accurate, Kevin? Is that inaccurate? I mean, it was a very funny comment, but it's the way that the commoners like myself feel sometimes.
Our clients are people like my parents. My father was a teacher. My mom never worked. Most of our investors are people that have worked very hard to accumulate a retirement of modest means. So I think when we think of the stock market, we don't look at it from the perspective of the rich. We certainly don't look at it from emotions. We look at it very carefully and in a very calculated manner from the specific companies that we own. And maybe we're a little bit more conservative than the overall markets, but we're not looking for the next Tesla. We're not looking for something that's very speculative. We want really good old-fashioned companies that have a great history of having taken care of their shareholders for a long period of time. Even to the extent that we're not looking for the next Apple or the next Microsoft. We don't own Tesla, but we do own Apple and we do own Microsoft. So I think the stock market is always a symptom of a front runner of the economy. The big question right now is, where's this disconnect? How the GDP is going to come out on Thursday, and it's going to be worse than anything we could ever, think about in a nightmare. The unemployment, Ted, you mentioned this earlier about being at historic highs, going from historic lows. We saw the most ferocious decline in the stock market over a 3.5 month period, and we created a self-induced recession. None of those things have ever happened. We talked earlier about the restaurants and the COVID-19 and nothing really having changed except that the numbers are increasing every day. So how the heck can the stock market be higher? It seems so counterintuitive, but the truth is that the stock market forecasts so much into the future that it is completely 100% saying that our brilliant scientists are going to come up with therapeutics and vaccines. 2020, we're not thinking about what those earnings are. Companies aren't even providing forecasts, but the stock market is trying to price things based on where it thinks that the economy can be a year from now, 18 months from now, and two years from now. So I view that as a very positive. How rich people think right now, I don't know. I don't know that many rich people, but I would think that they're all, on the Hamptons, not watching or listening to us.
Hey, Kevin, I'm wondering, a lot of people that may be watching today, it just is a great dialogue to think a lot of people do want to hear about the market. A lot of people do worry about their money and what's going on in this disconnect. What's your opinion about how things could, I realize nobody has a crystal ball except Lee, about what could happen under a Biden or a Trump reelection or a Biden presidency, that I feel nobody's even hardly talking about the election, and we're basically 100 days away.
Well, I was told there'd be no political or religious conversations by Lee.
Well, let's leave the politics out. I'm just saying, is there a viewpoint, you're in these dividend paying stocks, and I've always told investors that if you don't have 5 years to be in the stock market, then you shouldn't be in the stock market. It's just that simple. And so, but yet I feel the world has moved to where people try to time this thing and get in and out so quickly. And was never trained that way. I was always trained that if you don't have the time frame, you don't put the risk into it. But so when you buy these good quality companies, it doesn't really matter as much when a presidential change happens here in November.
Yeah, Ted, I think you hit it right on the nail right on the head. For the investor, it shouldn't matter. If you look back at the 2016 election, there was such a contentious race, and markets were incredibly volatile heading into it. And I would think that that's probably going to start next month. September, October will be the just incredible headlines. This is different because of so many competing headlines right now. But Wall Street is paying close attention to the polls. Wall Street doesn't like change. The stock market would prefer things to be status quo because uncertainty is always a cause for volatility. So regardless of your political affiliations, the stock market would prefer things to kind of stay as they are. And if they change, and if you see a blue wave or a Biden presidency, there's going to be volatility for sure. There's going to be some industries that are going to suffer as a result of that. There's going to be other companies and industries that will thrive as a result of that. But ultimately, over the long run, it's much less important who's in the White House as to what the corporate balance sheets look like. So I think looking back over the 30 years that I've done this, we've had a red White House, we've had a blue White House, and ultimately, to your point, if you're focusing on quality, it's not going to matter over the long term. Now, there's been a huge wave of traders into this market, which I think is great. And that short-term fluctuation will be very, very impactful on traders. As investors, I wouldn't say it's a bad event. That's not fair, but we look much further into it.
Kevin, because I think that what you're all doing is great, because it's really hard for retirees now and people that built up a nest egg to get income. The banks are paying almost no money. Interest rates are really low. The bond market, or what we talked about earlier in their segment, being a loaner, I think the 10-year treasury rate is almost 0.5%, right? It's almost nothing. So do we expect that, there's so much talk in the news about inflation going crazy and interest rate, but wouldn't interest rates have to go back up for inflation? You wouldn't have a period where your bank's offering 0 and inflation's 10%. Am I wrong in thinking that that's hard for that scenario to happen?
No, you're completely correct. And everything we think about from even a lay perspective is that you can't have rampant inflation without higher interest rates.
Right.
But my thinking is you can't have higher interest rates, just period, and just leave it there.
Right.
Because we've printed so much money. We talked about $600 going down to $200 or $300. It's still $200 or $300 for lots of people every week. So if you think of debt servicing, just for any one of us with our own balance sheets, our own budgeting, when you're the U.S. government, you don't want interest rates to be higher because your interest on this debt would be so massive and so problematic that hyperinflation would
So
run
Lee,
rampant.
one of the things in here, it's really interesting because Kevin's more brilliant mathematically than you and I combined.
Clearly.
I was told there'd be no math either.
No, here's the thing that people don't remember is that, we as a country, we basically have the same balance sheet and income statement that businesses have to run. And when you look at the expenses that the United States government pays, you have Medicare and Social Security at the top. You have defense as number 3, and number 4 and growing is the net interest on the debt. And folks, what Kevin's talking about in here is if interest rates went to 8, 9, 10%, the amount of money we would be charging ourselves on the debt would far supersede Social Security and Medicare. It's almost like tying a noose around your neck. Is it not, or no?
Absolutely. And all you can hope for is that we're able to keep a low interest rate environment long enough to begin to dig out of the hole. And we can. We have a great Federal Reserve. They've been ahead of this and proactive since day one. Even bipartisan politics has created stimulus packages. I think that we couldn't have done a better job considering what we faced and the reality of shutting down an economy of our size and trying to restart it while it's sputtering. But keeping interest rates low for the foreseeable future will help us to get out of that as a country. But what does that do for the retiree or the 10,000 baby boomers who are retiring every month? Or my parents who are living on a fixed income when interest rates are at a near zero level? And to your point, a 10-year treasury at a half a point or 0.6 isn't all that exciting. I mean, the price of things are still appreciating. There still is inflation. So the challenge for the person retiring today is just something that's so much more difficult than it had been even 25 years ago when interest rates were at 5, 6, 7%.
Right.
At zero, it's very, very difficult.
And guys, I'm going to interrupt for a moment and just pivot with us just a little bit. In addition to this is amazing information, of course, for someone like me, the layman, and also our listeners. I just want to give a little context, Kevin. You graduated from George Washington University and you started your firm, if I'm incorrect, 2005. Is that correct? So give a little context just on an entrepreneurial angle. What prompted you? We were speaking before the show, as you said, look, you might not be the most social person out there. You're not out in the middle of the world, doing tons of speaking engagements, hitting pre-COVID even, not being in the middle of everybody. But what prompts someone with, the finance background that you've had, of course, to say, I'm going to open up my own firm? Give a little context.
Well, I mean, I've always been passionate and I've always loved the stock market. And I've been in this business since I graduated in 1992. I fell in love with it in 1987 during the October crash. And not having money invested in it was a lot easier to fall in love with something academically because I wasn't, in line for government cheese or things like that. But I've been very passionate about the stock market, and starting Capital Wealth Planning in 2005 was a vision to be able to serve financial advisors. Previously I had served as a financial advisor and then worked in the institutional space, and we really wanted to develop a company that could provide alternative strategies, hedged strategies to the financial advisors, who ultimately can serve their clients with a menu of different offerings. And again, we represent usually a slice of an asset allocation. So a financial advisor will work with clients, and if we're lucky enough, we'll become a piece of that puzzle. We'll become a sleeve of that. And our vision at the time was to create strategies that would really help to buffer the downside of the portfolio. And to this day, we still do a lot of that, but most of the success of Capital Wealth Planning was really just me being in the right place at the right time and being very, very lucky. So I take little credit personally. I surround myself with really smart people who make me look good. And sometimes when it comes to luck, it's being able to recognize it and to take advantage of it. Because I think all of us, and especially for the entrepreneurs listening and younger ones listening to your podcast, it's having a great idea is one thing, and being in the position to market it and to be able to sell it is a whole nother ball of wax. And we've had many failures, 3 big ones, and those I think help to educate you and make you stronger and a better business person. The strategy never failed. It was the business endeavor to get it to the point that it is today. But I think I would credit most of it to good luck, right place, right time, and being a really, really good listener.
Ted, I will tell you, most of our listeners out there, we always say that about entrepreneurship. When you hear someone say they got lucky, you might see the one success story that they have, but you don't see the 99 failures or wasted time that someone like Kevin, who's being very, very humble here, I could probably say 999 wasted, the amount of wasted energy and effort to get that one lucky shot. So it's very kind and humble of you. Ted, I will tell you, Kevin is probably one of the most well-spoken guests we've had on the show. I'm intoxicated listening to him, but I'm shocked and I'm just blown away. We got him to say government cheese. I took a note of that, Kevin. You're so loquacious and it's beautiful and you're so professional, but for you to say government cheese has made my day. I just wanted to share that. It was a very poignant statement. I really liked that.
My father was a teacher, and sometimes during a teacher's strike in Philadelphia, when there was no income, a big block of butter or a big block of cheese in the refrigerator was cause for celebration. So
yes, my father was a teacher as well. I love it.
Never want to forget those things.
Yes.
You know, Kevin, there are a lot of people that see the money management business as a glamorous business, the glamorized movies that are out there. But the truth is, it's a pretty highly regulated business, isn't it?
Well, absolutely. We all love watching Billions. I mean, who doesn't love
Bobby Axelrod? Best show.
I toyed with wearing a Metallica shirt in your podcast, but I thought everything else, it would be too much. But you know, the truth is, it's very, very difficult to run a compliant money management firm. We spend more on attorneys and compliance than we do on anything else, and we're proud of it and happy to do it. But the thought process behind the glamour is you know, I can put that to I can put that myth to bed very quickly. I mean, look at me. Go to bed at 9:30, 10 o'clock at night. I'm up at 5:30. My guys and our trading team, we all sit in a dark, cold room staring at computer screens all day. Our eyes go bad. You're constantly looking at numbers and running charts. It's way better than it used to be from the standpoint of technology. You know, we're having this, I wish I was in Atlanta or Alpharetta with you guys in person, but, you know, we're able to communicate pretty effectively remotely. The same thing can be said with the computers and the ability to have the entire stock market on your phone. Being untethered does allow for, I think, a much better quality of life for the financial person, because in days gone by, I mean, from 9:30 to 4, we couldn't leave. We were tied to this ticker tape or Quotron, or when I started, there was one Quotron for the whole office. So things have certainly gotten better, but I would say they're still far, far from glamorous.
So let me ask you a question for the common person, myself, right? And even very sophisticated CEOs or high net worth individuals who are very good at their respective industry, but are not good financially, right? They latch on to a financial investor, or they maybe have an exit and they receive a lot of money. Kevin, you're very trusted, clearly, in the time we've spent. Someone like Ted is very trusted. What recommendations do you have for our listeners out there that are one of those people, high net worth individual, maybe having an exit, or even just someone who is going to be retired, as you said? You know, it's not all glamorous and it's not all rich people that you're wealthy people you're working with. How do they find an advisor? Obviously, we're going to find out from you before we leave how people get in touch with you. But what are some of the check boxes you would recommend for our listeners when trusting someone with their life savings?
I mean, I think next to your physician or you know, maybe your religious spiritual advisor, you know, your financial person is the most important outside advisor, not just for current investments, but for retirement planning, for your life and for your legacy, because taxes are such a massive component in planning. So I think working with a financial advisor like Ted and his team, and for folks like that around the country, you need a financial advisor that's going to help put you on the path to success, good or bad. I mean, there are times, I'm sure, when the financial advisor sits with a client and we're looking at a scenario of retirement, and you run out of money in these models, in which case you're going to have to make some hard decisions, which is spend less or continue to work. Fortunately, I'm removed from those conversations, but I would think that really making sure that you have a high quality financial advisor to steer the ship. There's lots of things out there that are, index based or inexpensive, and like anything in life, you kind of get what you pay for. So I'm a tremendous advocate for financial advisors, and looking at whoever he or she is. There's great resources off the government websites to make sure that they have some credentials, some credibility. Ask for 3 referrals. Who are 3 people you work with that are your clients that aren't related to you, and call them. Find out. Every person is different. Personalities need to gel. Investment philosophies need to gel. And most importantly, you need to listen to your financial advisor. If he or she is making a recommendation, it's probably for a good reason. So when you do disagree, maybe take a day or 2 to think about it, come back, reassess, and look for some compromise. But there's such a glaring need, because you're retiring now for 21, 28, 30 years. You're in retirement longer than you were in your work life. In the old days, it was easy. You just die, they'd shove you out of the way and stick somebody else there. But now, you need to figure out a retirement plan, and there are great, high-quality people out there, and I encourage everyone to find someone local and work with a good advisor.
Kevin, before we wrap it up, I want to ask you, and for our listeners, 30 years in the industry, 30-year expert here. I know you've never seen anything like this pandemic in our lifetime, of course, but give me your best guesstimate of the next year. Where do we stand in the economy, in the world, generally speaking, your next 6 month and 1 year best guesstimate? And then we'll go back and look at this and watch it in the next year to see how right you were.
Well, if I'm wrong, we just won't replay it. So it's 28 years, full disclosure, but I'm reading a Harry Truman biography right now, and I know that sounds like, where are you pulling this out of and why? But it mentions a time in the 1918, 1919, 1920 when we had signed a treaty to end World War I, and he was a captain in the United States Army, and he was overseas at the time. And this is a David McCullough book, so it's a hardcore read. But they only dedicate maybe one small paragraph and another sentence to this topic. But he's talking about the Spanish flu of 1918. And he references the fact that he actually felt safer being in Europe at that time because of how the flu and the virus was affecting citizens of the United States. And then literally the next sentence, and maybe I'm not quoting it exactly, but says something to the effect of, and within a year, it went away as quickly as it came. So I think back to that paragraph that I've been reading and hoping that maybe something similar can happen here. We have great companies that are beginning phase 3 trials of a vaccine. It will take a massive effort to get vaccines out there to the globe. But I think next year that's a reality. That's what I'm expecting to happen. And I think Wall Street's expecting that. And I would say 18 months from now, we're going to be in a very better position coming out of this. Some companies won't survive. Ted, you hit on this earlier. There will be displaced people from an unemployment standpoint. We won't be at record unemployment, but we certainly won't be at record high unemployment. GDP might not be cranking, but it'll be heading in the right direction. And if the consumer, who was massively supportive of this economy in December, it seems like a lifetime ago, but things were humming on all cylinders. And if the consumer goes out and spends, then we can get this back on track much more quickly. That's the camp I'm in. That's what I believe. That's how I'm investing. Yes, I'm a glass half full person at this point, but I think it's the right call, and I'll stand behind it.
Well, Kevin, for folks that are listening today, we may have financial advisors that are watching this that could certainly use you as a sleeve in their asset allocation, or even consumers that want to learn more about your strategies, how you work. I mean, such an important strategy in times where people are getting no interest at the bank right now. How can they get in touch with you and your company and learn more about you?
Well, we're based in Naples, Florida. Our company is Capital Wealth Planning, which you can find online under capitalwealthplanning.com. Or feel free to call me at my office, 239-593-2100. if you reference Shrimp Tank, we'll make sure to return the call quickly. Unless you're Shrimp Tank Canada, then no promises.
You know, there's a lot to be said for someone who takes the initiative to get a 2100 number, Ted. You see a lot of these businesses and whether they have a personalized number, but most just don't care what their number is. I tip my hat to you, Kevin. Well done on that.
The fax number is 593-2110. I think they did that so I could remember it.
Yeah.
Well, enjoy the rest of your time in New Jersey before you get back to the beautiful Naples, Florida. We just wanted to say on behalf of Lee and I, thanks so much for joining us on the Shrimp Tank today. Not only talking about your company and how you built it, but more importantly, just sharing some wisdom in difficult times. There's a lot of information between the coronavirus and the unemployment and stock markets going up and down and people trying to navigate it. So thanks for sharing your wisdom today.
Thank you, Ted. Thank you, Lee. Next year, when we look at my prognostication, I'll come to Atlanta. We'll do it live. And the only disappointing thing is I didn't get to hear the cool Shrimp Tank music. So
exactly right. Ted's going to wrap it right now for you.
Love it. I saw you hum it in my head.
Yes.
Thanks, guys.
Lee could rap for you now. Lee could do it if you
Oh,
want.
I'm not that good. I don't want to ruin this wonderful show you guys have done already. That's wonderful. Thank you so much, Kevin.
Yeah, thanks so much for joining us. And thanks everybody for joining us here on the Shrimp Tank. This is the reason we bring in some of the biggest and brightest owners and CEOs and just brilliant guests that have great insight to what's going on in the entrepreneur and the financial and economic community. Thanks again, Kevin, for joining us today. I look forward to seeing you all next week right here on the Shrimp Tank.
I've been feeling like a shark in a shrimp tank. Big fish, small pond in the shrimp